No change in the monthly bond purchases. They will continue at $85 billion a month, but there is new language on the pace of those purchases. The statement says the committee is prepared to increase or reduce the pace of its purchases to maintain appropriate policy accommodation as the outlook for the labor market or inflation changes. Goes on to say, in determining the size, pace, and composition of its asset purchases, the committee will continue to take appropriate account of the likely efficacy and cost of such purchases, as well as the extent of progress towards its economic objectives. It is maintaining its pledge to keep the federal funds rate at 0 to 0.25% in this statement. Currently anticipates this exceptionally low range for the federal funds rate will be appropriate at least as long as the unemployment rate remains above 6.5%. Inflation between 1 and 2 years ahead is projected to be no more than a half percentage point above the committee's 2% longer run goal, and longer term inflation expectations continue to be well anchored. There is new language on the economy. Information received since the Federal Open Market Committee met in March suggests that economic activity has been expanding at a moderate pace. Labor market conditions have shown some improvement in recent months on balance, but the unemployment rate remains elevated. Household spending and business fixed investment advanced, and the housing sector has strengthened further. But new language here, fiscal policy is restraining economic growth. Inflation has been running somewhat below the committee's longer run objective, apart from temporary variations that largely reflect fluctuations in energy prices. Longer term inflation expectations have remained stable. The vote was not unanimous. Once again, Esther George dissenting, concerned that the continued high level of monetary accommodation increased the risks of future economic and financial imbalances, and over time could cause an increase in long-term inflation expectations.